delving into stocks, property, bonds, economics, and more. This is the Stock Market Mentor podcast. Taking an unconventional stance, we challenge the industry to help you protect your investments and empower you with the knowledge to become a savvy investor. We don't provide financial advice. Here's Steve Moriarty, Tom Hill, and Jacob Sr.
Welcome back to another episode of Stock Market Mentor podcast, and today we're talking about the average versus geometric returns. My name is Jacob Sr. and I'm joined with Steve Moriarty, the guru and the Stock Market Mentor. How you doing, mate?
Easy.
It's a really interesting.
I'm good, mate. I'm good. Guru's a bit early in the morning for guru. Expert. I'll wear that label.
We'll go with expert. He's got an expert hat on today. Well, look, we're talking about average versus geometric returns, and there are a couple of words that people may or may not know. So I might hand over to you for the kind of why it's important to understand the difference in our field.
Yeah, sure. I think that one of the things that, if you listen to the industry, they're always talking about the average return, and if you talk to most people, most things are about the average, right? And that accounts for the variation, or what we're going to talk about later, which is the volatility in markets. You've got a guy who's 6 foot and you've got a guy who's 4 foot. Okay, the average is 5 foot, which in that field makes sense because you have in that statistical world, the average is made up of independent entities, right? So you get 100 men in a room, You measure them all, and you take the average. The stock market is not like that. The stock market is more of a multiplicative system.
Right.
And what that's doing is saying, and I'll give an example soon, but what it's doing is, in my mind, this stems from the theory, the efficient market theory, because it was done under what they call a normal distribution. A normal distribution is about averages, independent variables, and without going too far into it, we're not dealing with that world when we talk about investing in the stock market. So it's a multiplicative system. That's a bit early to be saying that word. And so the way I describe it to people is saying, well, look, it's like if I gave you a nail and said, Jacob, I want you to nail this into the wall. Here's a screwdriver, right? You'd sort of go, well, hang on, Steve, that's not the right thing.
Yeah, it's the wrong tool. I think it brings us on really. Anybody that you talk to in finance, it could be a friend or even an expert, and you say, how have you done over the last 10 or 20 years, they'll give you each year on average I've done 15% or 10% or whatever the number is.
Yep.
Seldom do they actually dig into what that 10% means.
Yes. Yeah. I was thinking the other night, I was writing one of my little ditties for the Friday, and I wrote, I've never been drunk. And then in brackets, on average.
Yeah.
Right? Because you can space out a bottle of wine over 7 days, which is, for example, a glass a day, or you can run them all into a Friday night.
Small glasses.
Right? So the point being that you hear this, the broad point is this. You hear, the stock market returns 8 to 10% on average over the long term. And so when you first, there's so many questions there, like, okay, well, what's the long term? Am I going to get the average? What does the average depend on? And when you start to drill down, let me give you a demonstration. From 2000 to 2020, in the US market, the Dow Jones returned on average about 5.13. Percent.
About,
right? But the real return, right, the geometric return, which we'll get into, was actually about 3.5, right, over 20 years. What you realise is when you talk about compounding and you show the difference between compounding at 5 and 3.5, it's a really big difference over the long term, right? And so the idea of people saying, if you sat down and said, oh, okay, well, what should I get, Steve? You know, and I said, oh, well, Jacob, you know, look, you could basically work on 8%, right? You go away and using the rule of 72, right, 8 nines are 72. Oh, okay, well, every 9 years my money will double. You don't get anywhere near that,
No.
right? You end up with a real return of about 2%, which is, you know, is really awful because you take the average. You've got to take away the volatility, which I'll talk about in a minute, then take away fees, taxes and charges because all of that stuff compounds as well. And so, and this is why I sort of, you know, we want to say to people, look, don't think you're going to get 8%, you know, because the real return is 2%. And at the moment, you know, May 2023, with high inflation, you're going to be getting even less, so you know, because it eats it away.
So, I mean, an interesting point. Why do you think the industry uses average over geometric? Is it because it makes it easier for them? Yeah, the numbers are bigger.
Jacob, Steve, what do you think I'll get? Oh, Jacob, look, mate, I think you'll be hitting 2.5%. Yeah. You'd be going, Jesus, is that it? That's all I'm going to get. What am I paying you for, you know, 1% a year for to get 2.5%? Yeah. Whereas if I say to you, oh, Jacob, you know, look, mate, I think you can work on 8%. You know, you automatically go, oh, yeah, okay, well, that's not a bad return. Gee,
well,
you know.
99% of people understand averages and you can...
absolutely.
You can kind of cookie cutter that and make someone a little bit happier if it's an 8 or a 10% return.
Yeah. And but the point being, which we were starting out with is, you know, it's no good... If I say, you know, the average height is 6 foot and I'm 5'9.5", well, you know, I'm a bit like, oh, geez, I'd rather be the average height. Thanks very much. So but my point being, when you look at averages, the average return is a compilation of individual returns, right? Individual returns, independent variables, independent men or women, you know, and height. So they're completely separate and there's no influence. Right. So that's the first point. The second point is that because it's multiplicative, you've got to use the geometric return, okay? And so that's where the average of 8 falls to a geometric return of 6. Now, the 2% is for the volatility, okay? And so let me give you, there was a Reserve Bank study done in 2019, and obviously not widely publicised. And the reason why is pretty simple, because what they said was, look, over the last 100 years, I think it was 100 years, they said that the stock returns were actually 6% geometric return, right? So that's the figure you should be working off, right? That's the real return. That's the money you get. Now, what they did was then went and said inflation is average 3.9, so now you're down to 2%, right? So that and that's what I mean, where you sort of look at it and go, God, that's, you know, I don't want to be rude, but it's like, that's pathetic. Yeah. And that's without taxes, fees and charges. Right? So when you look at it, the 8 to 10% is really, really deceptive.
It is, yeah.
And what it boils down to is basically what we're going to talk a bit more in the next episode is that what we're doing is talking about the different times that you start investing, whether you're in a bull market, whether you're in a bear market, because hopefully people will know by now, when you're in a bull market, you get above average returns. But then in a bear market, you get below average returns.
Which gives you the average return.
Right? But then when you look at that and say, well, what was the real return? What the RBA is saying is, well, look, because of all that volatility, and we'll talk about the maths of it in a minute, because of all that volatility, you're not getting 8%. You're actually getting 6%. Then you've got to talk about taxes, fees and charges and inflation. So
then you start to get to the question, well, why would I even approach an expert in the first place?
Well, yeah, we said in earlier episodes, if somebody genuinely adds value, like Warren Buffett, for example, right? Like you'd say, well, Warren Buffett's worth paying for, right? Because he's got a long history and he's got, great returns, right? At compounding the money. That's different to a lot of people who invest in superannuation or manage funds, because again, when you look at the returns, there's very few of them that actually outperform the market. And so what we're saying is, well, hang on, you can do it yourself and do better than the fund managers, because once you understand the concepts we're talking about, you get to see that it's actually not that difficult. Right? You can buy index funds, you can buy country funds, sector funds, ETFs, sorry, and you can do that yourself. So the expertise is actually misleading, because a lot of the time they can't sustain that performance over the long term. Will you get a bunch of Harlem Globetrotters that walk into the room and raise the average height? Yeah, you will. But will you get them for the next 25 years? No, you won't. And so, again, that's where we go back to talking about the length that you're investing for when you start out is super important.
Well, it brings it back to the three principles we've been talking about for a few weeks now: time theory and incentives.
Yeah,
incentives, I feel like plays a huge part in this. The industry are wanting people to get into the market. They take their 1%. They tell everybody that there's an 8 to 10% average return over the last X amount of years. And it really just falls into that incentive for them.
Yeah. If you have a look, there's a chart around by Vanguard, and when you look at it and it's over 100 years. Well, the average return over 100 years is, let's, for argument's sake, say 8%. But my argument is, well, hang on, I didn't start investing in 1923, right? So it's pointless. And that's where you then start to get down to the mechanics of, well, hang on, if I don't get the average, what do I get? Now, the answer from a legitimate perspective is, well, Jacob, it depends.
Well, right? The average investing career for somebody might be 30 to 40
years. Yeah. But it's also saying, if I said to you, oh, Jacob, the average return over 20 years, 8%, using that example before in the Dow Jones, you'd be going, well, hang on, Steve, the last 20 years got 3.5. So what I'm saying is it's much easier to say what's the average, rather, because that's a single point data, what I call single point data, right? It's a static figure. The important figure for individuals is, I know the average height's 6 foot, but I'm 5'9". So, mate, that doesn't apply to me. And so from that point of view, the only answer to a question of how much should I get, Steve, is, well, it depends, Jacob. What does it depend on? Right? And so that's where we get a little bit more technical. So let me run a few numbers here just to give you an idea about the influence of volatility, right? And my apologies, I'm going to read this. But let's start with $100, right? And you're investing. So you get 5%, then you lose 30%, then you add 25%, and then you add 5%. Now, trust me on the maths. If you add them all up, you get a 5% average return, right? But that's plus, or plus minus, plus.
Yep.
So if you look at the geometric return, which is times, what you get is you end up with $96.47, right? Now, why do you do that? Because in the first year, you're getting, in the second year, you're losing 30%, not of 100, but of 105, which is a bigger figure, right? Now, if that's not bad enough, when you make 25%, you don't make 25% on 100. you make 25% on
Of the lower
$73 or something, right? So that's the problem, and that's why volatility is really awful, because it eats away at your returns, right? It's just purely mathematics. And so that's why we say to people, you really want to focus on not losing money, right? Because of the mathematics of it. And what it expands out to is, I had a really great bull market where I made lots of money, but then I had a period where I lost 50% or 20 or 30 or 40. And that's the problem, because over the average of 8, what we see is bull markets with, 11 to 15% returns on average. But then we get bear markets where the average actually loses money.
Yeah, well,
right?
I know so many individuals, friends and parents of friends particular, that went through the COVID-19 flash crash.
Yeah.
And they were just about to retire.
Yeah.
And they did retire and took the money out of the super funds, and they'd lost 30% in a few months.
Yep.
And that wasn't 30% of the original bet. It was 30%
Yes.
of the end bet that they needed to retire with.
Yeah.
And it's so critical to understand that point, that then they wouldn't actually have to make 30% to break even. They'd have to make 100%.
Yep. That's the problem. You lose 50%, you've got to double from the point. So at 100, you lose 50, you go to 50. But from 50, if you make 50%, you're only back at 75, so you're still underwater.
Right.
And what saves most people is that constant flow of basically dollar cost averaging. Right? That's what it boils down to. And what we're saying is, once you understand the average and geometric return, and you understand the impact volatility and maths has on your returns, you take the next step to go, well, hang on, therefore I should wait for the market to be really cheap and put more money in, then I should just continue feeding it in.
Yeah.
But as you mentioned before, feeding it in is what the industry likes. That's what's better for them. Because, as I've said to people, if you came to me, like at the moment, where the CAPE ratio in the US is at 29 or something, it's quite high, right? The probability of losses is very high. If you look at where the CAPE has been 29, right? The Great Depression, the year 2000 and 2007. So you look at that and say, if I said to you, oh, well, Jacob, from here, the average return's probably about -5 over the next 10 years, you go, oh.
You'd sit on your cash.
Well, you'd sit and say, or you'd say, oh, well, Steve, I think I'll go buy property or I'll buy bonds or something.
Or gold or whatever.
Yeah. So we get lured away by thinking, oh, yeah, I'll get 8%. And what the industry do is say, oh, Steve, you can't time the market. You just got to suffer through these drawdowns. Well, that's clearly wrong.
Yeah, I mean, humans aren't naturally that good at holding their nerve as well. So the industry plays on the fact that we might miss out on the 8% or the 10%, and hence why people just constantly dollar cost average in for the rest of their lives, particularly with super funds. It just happens while you work. But if you were to say to somebody, hey, maybe don't dollar cost average in at this particular point when the CAPE's at 30, and start to save all that, put it in a bank account, and then put it in to the market when the CAPE's at 15, the questions you'd start to get from people, particularly my age, might be, well, what if I miss out? What if it's not the right advice? Yeah. And it's so easy for the industry to play on that.
Yeah, it's the same thing, we were talking about before we started recording. You generally, if the mechanic says, look, Jacob, this is what's wrong with your car, you generally go, okay, fair enough, that's must be wrong with my car. The reason is because you don't know about cars. That's why you're going to a mechanic. But the analogy we're trying to do, or we're trying to say, is that it's more or less sort of saying, no, what you've got is a two-wheeled scooter, and it's really obvious what's wrong. You've got that knowledge, and so the industry is somewhat misleading by using the average return. But it sounds a lot better than the real return, and it's a lot easier to I suppose, market those numbers than the real numbers as the Reserve Bank showed, right? I think one of the things is you've got to have the right questions to get the answer, right?
Well, that was going to be my next question for people that are listening to this going, okay, I get it, Steve, Jacob, we get it. Average is not the thing we should be looking at. It's geometric and real returns that are.
Yep.
What are the questions I need to ask my finance guy to ensure we're on the right track?
Well, you have to look at it, excuse me, in terms of valuation. So one of the big deceptions is, I think anyway, is you can't time the market. That's the mainstream argument, right? It's impossible, Jacob. Can't time the market. Therefore, you just keep putting money in. I mean, to me, that just sounds really dumb, right? Because we've got really simple things like the CAPE ratio, market cap to GDP. These ratios which tells you when things are expensive. Then the next question is, okay, well, if it's expensive, I shouldn't buy a lot. But there's all this idea of, you can't tell the future. But when you look at the stock market history, it's, to be blunt, it's bloody obvious.
Yeah.
Right? It's really obvious. It goes up for a bit and then it goes down for a bit. And a bit, I mean, a series of years. And so, and the other point being, what I sort of say to people is, look, you only need one good bull market. And if you've got any brains, you'll do really well. But the point being, you can't just let it run forever.
Yeah.
Right? When you get those, like you talked about with the COVID drawdown, they take away from your returns enormously, right? And it feeds into this other idea of the sequence of returns, right? And again, because of volatility, it really damages the way the returns that you get, because it's really important about how you start out. Right. And, sometimes in football or AFL or soccer or cricket, if you get off to a bad start, that's it.
Yeah.
It's game over sort of thing.
I think Taleb talks about this a lot as well, where, you use two people, for example, they both have $100,000. The first one has a 50% win in the first year.
Yeah.
And the second one has a 50% loss in the first year. And they compound for that. Every year after that is exactly the same. It is astronomical, the difference between person one and person two. And it may have just been the difference of person one's used a little bit more common sense, they've timed the market, or they've got lucky and they've put their money into the market at a time it was relatively cheap compared to person two.
Yep.
And so people don't understand that how you start is really everything. And if you are looking at getting into the market, it's worth just understanding the simple tools and concepts that can price the market in general for you to say, well, maybe I'll wait a year or two. Because if you do take a big loss in the first year, it's not as if you can just replace that with your own cash. And if you can, amazing, but most people can't.
Yeah, you look at those things where they go, the market's bounced 10% this year, and it's like, oh, that's good. It's like, well, actually, it went down 22% last year, right? So you're still underwater. So that's the point. There's this constant focus on the short term, and I've had people say to me that their financial advisors are sort of like, oh, you're missing out on all these returns. And it's basically like, well, yeah, okay, but the problem is you didn't get me out of the market when I missed it. I didn't miss the 30% fall either. So, you then got to make 60 or I think 55 or something to get back to where you were. So a 10%, hey, the market's bounced 10%. It's like, great, now I'm only down 45%, right, or 25%. So the point being, that's where the volatility, the mathematics of volatility hurts you. That's where the sequence of returns hurts you. Because as you say, if you start out at 100 and you have it, 3 losing years, like in 2000, when it doubles from 2000 to 2007 in the US, I'm talking about, you actually didn't make anything because you started when the CAPE was 44. You had 3 years where you lost 50%. Then you made 100% in 4 years to get to 2007 to where you actually go back to break even, right? Then you suffer a 50% decline again to 2009. So in that decade, it's just an absolute wipeout.
So what indicators, I know we've mentioned K, even if it's just that one, what indicators should somebody be looking at to indicate whether to rebalance and take some money off the table?
Well, we use the CAPE, which is strong correlation. You know, there are others, market cap to GDP, which we'll talk about in future programs as another indicator. Generally, what you find is when CAPE is expensive, most macro valuations indicators are all expensive, right? There might be a little bit of variation, but not a lot. So the other one, which we've talked about earlier in earlier episodes, is the earnings yield.
Yep.
You know, it's a really simple thing because what it's saying is just ignore that daily fluctuation.
Noise,
you know, which everybody wants to talk about. Oh, the market moved 1% today. If you're investing for 30 years, that's got nothing to do with it. But starting out in 2000 really has something to do with it, right? And that's because the starting valuation is really high and the earnings yield is really low. And that's why if you said to people, what's the average return? And you said, well, at the moment it'll be, you know, it's potentially negative, then most people would say, okay, so what should I do? And as you say, you'd say, well, you should either go and buy a property that's cheap or, you know, invest in something that's got a better yield.
Put it in a bank account for that.
Or put it in the bank account, right? Just leave it there. Because again, the idea of compounding, as I say, is if you compound at 10%, you'll double the money in 7.2 years, right? Rule of 72. If you compound at 5, it takes 14.4 years. So in other words, what I'm saying is you can wait a long time in cash and it can be really painful. But if you wait and then your earnings yield says, Steve, Jacob, now I'll give you 11, that's when you want to put a lot of money in. Right? But that's not, Jacob, you're going to get 8%.
No.
Right? Because you're going to get 11 because you're buying when things are really cheap.
Yeah.
Right?
So patience is a virtue in the markets, and people. Well, it goes back to my point before. Most people don't have the psychological stability to just wait.
Well, it's just hard because there's, you know, like we talked with signal versus noise, you know, like there's this constant chatter every day about, you know, the market did this and the market did that and, you know, all that sort of stuff. And so you get emotionally drawn into that. You know, it's like, I mean, we may have discussed before, you know, it's like going to a party. It's an absolute booze hound, but you're sitting there as a non-drinker. Like it's really hard, right? It's just like, oh, well, I'll just have one drink, you know. And that market thing is, again, that idea of, oh, Jacob, you know, you don't know what the market's going to return, mate. You've got to be in it. And it's like, well, actually, no, that's not really true. And we'll talk about that in the next episode. But I suppose to summarise it, it's basically saying always ask what the geometric return is because that's the one that you're actually going to get. That'll give you a picture of real returns. And again, the one we sort of recommend all the time is ask what the starting valuation is, right? And what the historical average is because that will give you a good guide as to what you're going to get. But when you see someone say, oh, the average return is 11%, ask them, okay, that's good. What's the geometric return? Right? Because that's the way stock markets operate. They don't operate on addition, right? They operate on multiplication. So that's why it's really, really important to understand average returns versus the geometric returns.
That's awesome. Like I don't have much to add to that. The summary is great. I think just be skeptical of average and start asking the right questions because it can genuinely save you a lot of money and be patient.
Yep, absolutely.
Perfect. So next time we'll be talking about
rebalancing versus buy and hold, I believe.
Yes, it is. And they said genuinely, again, another great topic. And it folds straight into average versus geometric, and then how we can start to debunk the myths of buy and hold. So we'll speak then. Thanks,
Okay.
Steve, for joining.
Cheers, mate. See ya.
That's it for another episode of Stock Market Mentor. We hope you have enjoyed the show, and if you have any questions about the episode or want to discuss how we can help you become a better investor, please feel free to contact us at support@stockmarketmentor.com.au. We'll see you next time.